let's kick off this session now. I'm going to do the quick intros here because I feel like I kind of got a cool story about everybody. Not a personal story, but Jason Halper, who we've known for many years, first as an author. He wrote a number of very interesting papers that were published on Transaction Advisors with regard to different issues as they changed, and board and governance issues, M&A litigation as that landscape was shifting. And then we ultimately recruited him to speak at our conference series, and so we're pleased to have him now for the first time in San Francisco join us today, and he's going to moderate this discussion both amongst the panelists and hopefully amongst all of us. Just to, what would it be? The right. Let me show it. Dan, I recruited. Dan Madden has served as the chief financial officer of a public company in the pharmaceutical biotech space that's just gone through a transaction with another public company. And so as a chief financial officer, he's had responsibility for a massive deal that's just wound up. And so he's got some, I'm sure, scar tissue and war stories that maybe he'll share, as well as past efforts, but one that's very, very timely. Jen Muller, I wanted to recruit because, one, she was recommended highly by others, to bring a view with regard to opinions, fairness opinions in particular, that are required by the board special committee in many instances to opine on the consideration of a deal, whether it's fair, what an opinion is, what an opinion is not. Is it the highest and best deal? Jen's going to explain what that means as a key board and governance issue. Now, Sunil and I have known each other for many years, partly because he sits as a board member on a number of public company boards, including some that we know, Spire and others that he's been involved as a board advisor with. So we've asked Sunil to bring a private company board member view to this conversation. And so with that, Jason's gonna lead the discussion from public issues, private issues, but ultimately the spirit of this is, what are the key issues today that the board needs to know to get them ready to do a deal? And Jason's gonna lead us to that conversation. Thank you.
Thanks, William. So we're gonna try and cover a lot of ground in a short period of time. A lot of it's going to be sensitizing everyone to the issues that come up. We're gonna talk about considerations that go into whether a private company should pursue late-stage financing versus a liquidity event, an IPO or a acquisition. If the company is going to pursue a liquidity event, what are the advantages and disadvantages of an IPO versus being acquired? And then what does the board and management need to be doing throughout all these decisions in order to essentially run a good process and withstand scrutiny in a lawsuit that will inevitably be filed after a liquidity event, and which keeps me in business. This whole area, and particularly the pivot point between a private company and a public company, is attracting more and more attention these days. About a year ago, the then chair of the SEC, Mary Jo White, gave a speech at the Rock Center at Stanford talking about the challenges particularly for large private companies, the unicorns, because one day you've got this very large organization, one moment it's private, the next it's public, and it has all the challenges associated and the regulatory burdens with being a public company. And she talked about the fact that the federal securities laws, at least certain of them, apply to private companies. They certainly apply once you're public. The challenges with internal controls and governance. And that's just one example of the increased focus. There are academic studies about whether the securities laws and that whole regime should apply to private companies, especially the big ones. And so it's an area that's going to receive attention going forward. It already has, and it's what we're going to talk about today. So, Sunil, if you've got a company sort of in the late stages where it could potentially go public or seek to be acquired, or alternatively seek another round of financing, what are some of the factors you would consider in making that decision?
So happy to be here. Thank you for having me. With regard to late-stage private companies, the ones that we would back at Bessemer, I would say that we when we invest, even at the Series A, Series B, it might be 3-5 years away from liquidity. As we approach a certain level of revenue and we start to gear up for a proactive IPO process, then we do sort of a different set of activities. Whenever it's M&A, in my 6 years at Bessemer, it's almost always come, the good M&A, which is the one that we want to talk about, comes sort of out of the blue. So we're not really prepared for the M&A side. But on the IPO side, we do prepare by setting up more professional committees on the boards, audit committees and compensation committees. Sometimes we don't have those in proper form. The processes are happening, but we want to set up the board properly, and then what we'll often do is add 1 to 2 independent board members as well to sort of round out the board beyond just founder and representatives from each round of financing. So just beyond common and preferred shareholders, we'll add 1 or 2 independent board members too as we gear up. And those are actually relatively quick processes. The longest lead item that I've seen is bringing on a public company ready CFO and having that person sort of reform the finance organization, really ensure that things are running clean and proper. And that can be upwards of a year to get that sorted out. So,
What's entailed in getting that process up and running? Why does it take a year?
That's a good question. Perhaps Dan is better qualified, but I'll tell you from my perspective as a board member, what often happens is that, there's a big transition from sort of finding product market fit to getting customers in the door to sort of turning it into a company that public investors will understand. And so things like revenue recognition, things like ensuring that all our processes are clean and well documented, various compliance items, which I'm even less familiar with along the way that the CFO handles. Those are important and those take time, but I think more importantly, we want to feel an incredible amount of confidence in the CFO before we go public and before we start the roadshow. And that just takes 3 or 4 board meetings, and that could be quarterly board meetings. So I'm sure they're doing stuff under the hood that I'm not familiar with all the little details, but they're important things that set up proper transparency and inevitably 1 or 2 things are uncovered where, we forgot to do this and we need to clean that up or hire a new firm to change out this system. And so once those are in place, it ends up being a little over a year.
Dan, do you want to add?
Yeah, I think my experience is really with public companies, but I've found some that have been previously private and seen some of the issues you have to deal with post. I think a couple of things. One, your auditors are typically going to give you a little bit deeper set of scrutiny when they know you're going public. So even if you have been getting regular audits, et cetera, you may have some issues to deal with, as Sunil mentions. Of course, you got to get ready for SOX. You got to get ready for a different level of financial reporting. You got to get your SEC reports. It just takes a while to get your first SEC document.
The switch?
There's a little switch on the
I think
the
I have
box.
that.
Is it?
Oh, maybe not. Must hit it.
There we
Is
go.
it there? Okay. So I think the thing that I think is really important and often not discussed, though, is you have to be ready to be able to accurately predict your results, forecast your results, and make sure you know how to hit your results. When you start putting out guidance or having to live up to expectations, I think there's a famous IPO that happened recently that missed their first set of quarterly expectations and announced that yesterday, and they got hammered. And I think one of the most important things actually is starting to make sure you have a good cadence to setting up a good forecast process that's reliable, and hopefully demonstrate that before you actually go public. But I think that's one of the most important things to make sure you have in place.
This sort of gets into the regulatory and infrastructure burdens associated with being a public company. Is that, Sunil, in your experience, a reason at least to delay an IPO?
So I think you're going to have differing opinions from different VCs. There are, the last 2 or 3 years with, let's say 4 or 5 years, with the relatively robust later stage financing market, there have been many people who sort of retroactively rationalize investing decisions and sort of financing approaches. And so a lot of folks will say that they're raising a round to delay an IPO. I'm not sure that that's their optimal strategy. I think many of the investors would prefer, their typical hold period would dictate that they would be out of the company in that window of time. But given what many bankers tell us is sort of there's a good IPO window or bad IPO window, if those don't line up, then, and if there's later stage investors, like almost public equity investors who are dipping into later stage market, for whom they have a lower diligence bar than is typical, and we're able to have an option available to us that wouldn't be available otherwise. I mean, for us, if we're growing a later stage company and it's cash consumptive in the sense that they're deploying all the profit into future growth. We'd like to continue on that growth train and not slow things down by having to make it cash flow profitable. One way is to go public, another is to take later stage financing money. And so I think we've seen a lot of that. I think it's been driven by the IPO window being tricky. But at the same time, I don't know that it's the healthiest thing in the world for these companies to stay private longer and longer and longer without the public company oversight, without the liquidity, because then there's a whole separate set of derivative markets that emerge that don't have the same level of oversight as public companies.
There's been a fair amount of commentary about a dual track approach to a liquidity event, so a company pursuing both an IPO and an acquisition at the same time, and sort of letting the world know that at times at least, that was the approach. What are some of the reasons either to take that approach or not when in a sales process?
It's a good question. I'll start by saying I don't have personal experience with a company trying that. As I was alluding to earlier, M&A in my experience sort of arrives unexpectedly and it triggers a process, but that's usually not enough lead time to try and do an IPO as one of your options. I think it was at AppDynamics that was trying to go public, and it's funny, I used to be part of that Cisco Corp Dev group as a summer intern in 2008, but as I read, it seemed like within the span of a week and a half or something, they sort of swooped in and from cold start to consummated deal, or at least consummated offer happened very quickly. So my sense is that that's more typical. I don't know that there's many companies that hire a bank, go on an M&A path and an IPO path at the same time, and I just don't have personal experience with it.
Is it different if you are a small company versus a unicorn or something approaching that when you pursue a transaction or an IPO? In other words, small company have less leverage. Is there informational gaps for a smaller company, or is it hard to generalize?
If we're talking about acquisitions in the, let's say, $50 to $200 million range, maybe that's a kind of small company versus IPO. My experience is, it's a completely different process. There's a totally different set of acquirers, and there the main dance is sort of proving that this company is still successful and is choosing to be purchased at that stage, as opposed to an IPO. It's sort of the natural, things are continuing to grow, let's go for it path. But anytime any VC or any startup sort of puts itself up for sale with a implied valuation that's in that range, the question is what's wrong, right? There's the signaling of just the act of wanting to sell, and wanting to sell for a less than stellar number is an issue, and that comes up over and over and over again. And so there's a wide variety of sort of reasons people can dance around as to why that's an option right now. But in general, I think folks try to make it seem like that there's an opportunity, a short opportunity to do this before they go out and finance. I mean, it's a little bit of what you're talking about, the dual track. Having a BATNA helps to pursue the actual strategy you want. In this case, what I've seen is folks who, money's dwindling, as it always is in startups. Proactively, it's sort of the runway is shrinking. And so as it approaches, you talk to follow-on financing and talk to M&A at the same time, and just sort of say that, tell one you want to do the other, and that strategy works most of the time.
Okay. Let's switch gears a little bit and talk about what management and the board needs to be doing around this process. Dan, as a CFO, a senior member of management, confronting this kind of situation, what's management doing in terms of helping the board do its job?
I think initially you should have a pretty good dialogue with your board over the course of time to help make sure they're very familiar with your strategy, your business, the health of your business, its prospects, its risks, et cetera. I think when you get into the context of a potential deal, the emphasis there's a much brighter light shined on that process, and they're going to have to make a very difficult decision, and a decision that will be scrutinized heavily. So it's really important to make sure that they're up to speed. I think A lot of that comes with, typically, most companies do some sort of annual strategic review that has a financial model tied to it. You spend time going through that. Every business tends to have its own cultural bias, I think, when they're preparing a forecast. Some are conservative, some tend to be optimistic or really optimistic. And I think especially in the context of a deal, it's really important for the management team to help the board understand what the underlying assumptions are, where the key risks are, where the execution risks are, and where the upsides are as well. Because that's going to become the foundation for all the work that the bankers are going to do to help, test the value of the company and make them feel confident that they're making a good decision about, stay standalone, do a deal or not. And that model is going to get beat up left and right. And so, by participants who might be participating in a process and doing diligence on your model, the bankers are going to look at it very carefully, and it's going to be publicly available at some point, or some summary version of it. It has to really be ready to withstand that test.
And that can't happen on day one.
That cannot happen on day one. I mean, in our case, what we did, I thought was a pretty good practice. They were doing it when I became CFO, and I continued it. Is we had an annual review, an annual strategic review, followed by a financial model. And a good practice we did is, after that review with the board, we would come back with our financial advisors, with a set of financial advisors, and they would walk the board through what's the current capital market look like, what's investor sentiment on our company and in our industry in general, what are some of the deals that have happened in our industry and where those valuations at, who are the typical acquirers or likely acquirers in the space in general. And really have a dialogue with the board about, hey, if you are able to execute on your strategic plan, this is a range of values that your company might be worth. And the goal was to make sure that the board was always ready to respond effectively if ever there was an inbound inquiry, or even a hostile inquiry, or whatever the case. Just, it was really a preventative measure. And it's certainly, in our case, our last deal that I was involved with, we had inbound inquiries, friendly, that led to a market check, a typical market check type process. And it just really helped us get jump started. We, of course, had to respin everything. It's very typical. You're always going to want the latest view of the business. But we were starting with a pretty good background and context with the board. And again, maybe just putting a little more scrutiny and a little more exposure to the underlying risks and upsides and assumptions that went in the model, so they really understood what we were working with.
Jen, you're an outside advisor. At what point are you guys typically called in? Is it only when a transaction emerges, or is it sort of on an ongoing basis to give advice?
Well, we don't do research and trading. We're usually not coming in to provide kind of ongoing advice. We don't cover company stock, et cetera. So our role is often a little bit more limited to M&A. But what we're finding more and more is that for a number of reasons, including litigation, that boards want more understanding of what their strategic alternatives are. And that process shouldn't be happening at the end of an M&A. It's surprising you say things that seem so obvious, but yet when you read the Delaware opinions, you can see that sometimes things go sideways. And so it's really important for a board to understand, and I think it's great that Dan advises his board early on in terms of what's the value of the company, and what the understanding the projections and what that implies in terms of value, because through the course of an M&A assignment, those projections are probably going to change. Value is going to change, and the board has to have some kind of a baseline to one, compare potential bids for the company, but also to understand how the value of the company may be evolving or changing throughout the process. Because if they don't understand it, it may, in retrospect, look like there's some type of manipulation that's going on, that the projections are changing in some nefarious or way, that maybe the financial advisor is altering them, or they're in cahoots with the management team to try to force some kind of a sale or make a transaction look fair when it wasn't otherwise. And so with Dan kind of laying that groundwork of making sure that the board understands projections, understands what the upsides and the risks are, really helps us do our job. Because a lot of times we come in and they may or may not have that discipline already in place. So we come in, we're coming in earlier and earlier, and we're starting that process of valuation earlier. When we, a decade ago, a lot of financial advisors would avoid putting too much value on the table earlier because it may get scrutinized later. But I think that's being, I was going to say trumped, but by the importance of making sure that the board understands these issues over time.
Yeah. So I want to talk about some of the pitfalls that are out there in terms of a board process. And just to set the stage, and I'm going to keep the legal analysis to a minimum, the board's obligation in certainly a sale is to, well, always, its fiduciary duty is to maximize shareholder value in the long run. And there's lots of different ways to do it. Delaware, which is where most corporations are, requires a reasonable process by a fully informed, unconflicted board. And so, but the devil's in the details. And the question is, when will a process be deemed to have been done by a fully informed board that's free of conflicts and that's going to withstand scrutiny and lead to an appropriate result? So one of the issues that has come up repeatedly in the last few years involves conflicts either on the part of outside advisors or outside advisors who are deemed not to have done their job properly, perhaps manipulating a fairness opinion to achieve a result desired by management or for some other reason. So Jen, maybe you could talk about your experience in that area.
Sure. So you mentioned fully informed. So the board has to be fully informed, and the stockholders also have to be fully informed, and that's even more important now because of some of this new case law. But in terms of making sure that the board is fully informed, with respect to hiring a financial advisor, it's very important that the board understands any kinds of relationships or potential conflicts that the financial advisor might have. For instance, let's say that the financial advisor has a very strong relationship with some of the buyers, or maybe even offering financing to finance the transaction to some of the buyers, and may have significant financing fees that outweigh the fees that they're getting on the sell side in the M&A transaction. And so they may be biased or leaning towards particular buyers. And so what we've seen in terms of really standard practice now is that the financial advisor will provide some kind of information to the board even before being hired, usually in the pitch process, to inform the board as to what types of relationships exist with certain buyers. And it becomes very complicated quickly. What buyers are we looking at? What if a new buyer comes in the middle of a process that we didn't anticipate? What type of disclosure is really helpful to the board to understand whether or not there's a conflict? So it gets complicated, but it is now a pretty standard practice. And it's important for the financial advisor to make sure that the board has this information. Otherwise, we could be aiding and abetting in the board's breach of their fiduciary duties by withholding information from them. So it's in everyone's best interest to make sure that this information is provided very early on.
Yeah, I mean, there's a case that's pretty well known in legal circles, at least, where the outside advisor was found to have aided and abetted the board's breach because it didn't disclose a whole host of relationships with the buyer while it was advising the seller. And to the court in Delaware, that tainted the whole sales process because of how significant the board's financial advisor is to that process. And so there is just much more attention given now to the issue of conflicts early on.
And it seems like what's really most important is just making sure that the board is aware and that they've deliberated. They may still continue to hire that financial advisor, but they can understand what conflicts might exist. They can maybe change the financial incentives to try to work around that. There may be a second financial advisor that's hired to ride along in case it ends up being that particular buyer where there's a conflict. The other financial advisor can step in There might be just a second opinion at the end. So there are at least ways that the board, once informed, can work around it, but they have to be informed. The biggest area where I've seen, like I remember Vice Chancellor Laster in the Delaware Chancery Court just saying, if they don't know about it until the end, or in the proxy, the disclosures in the proxy statement that there was actually some kind of a conflict that existed, there's no way that that couldn't have potentially impacted the transaction and the board wasn't aware of it. So it's just important to make sure that there's full disclosure.
And I would say in the case we're talking about, the conduct was pretty bad. While the advisor was advising the seller, it was trying to provide staple financing to the buyer. It was manipulating the timing of the auction to facilitate a deal because it would get much higher fees on the financing than the advisory work, and none of that was disclosed, of course, to its client, the seller. But it happens, and that's what the Delaware courts have been cracking down on. You know, another area which gets into it's sort of similar, is management projections and whether they're reliable or not. It's related because it's the financial advisor's job to scrutinize those projections. Now, there have been instances in other cases where the financial advisor doesn't do that because it's trying to achieve a certain outcome. In other cases, though, the Dell management buyout, which happened within the last year or two, the board lost faith in management's projections and hired the original financial advisor had bought into them. Dell had missed projections, their guidance, for about 8 quarters. And they brought in a new financial advisor to sort of rebuild the entire set of projections. So that's a board that did its job. But Dan, how does that happen? How does you miss 8 quarters in a row?
Well, I don't know.
I'm not. Dan was not at Dell.
You have to be not paying attention, I think. Look, you know, there are a lot of debates sometimes about, do you show an upside to your prospective buyers? And I think best practice, you're typically going to show the same case to the board, to the buyers, et cetera. I think not having that continuity is very risky from a legal perspective. So, you know, especially you have a track record. If you put something out there that is too out of line, or you have a bad track record, the buyer's going to attack your projections no matter what. It's the first thing they're going to do. I've done that when I've been on the buy side. You always just figure out, am I going to take it down by 10% or 20 or 50, or what are we doing here? I think if you have something that is that incredible, uncredible, everybody's going to not look at it right. I mean, and I think you may even lose value. That's just my personal opinion. If I put I feel if I put something forward to a prospective buyer, even that it was just not credible at all, the whole negotiation can be different. I put something credible that I can defend, you're always going to be better. I guess a board probably ought to be asking questions about whether you have the right management team when you miss 8 quarters in a row. I mean, who knows what we're talking about here. Quarters can get missed. If you were CFO long enough, it's going to happen to you at some point. But I don't know what else to tell you. It's 8 quarters. I'd be pretty skeptical of any projection from a team that missed 8 quarters in a row as well.
Well, you mentioned providing potentially a second set to buyers, and I've seen that where certainly there might be an upside that's given to the buyers, and then a base case that's not given to the buyers, and they're called those to try to distinguish. But when there is an aggressive set of projections, and that's the only set, and that's provided to the buyer, it puts the financial advisor in a difficult position when evaluating the offer and whether or not it's fair. Because we're working with the same set of projections, and this crazy set of projections says the company is worth $1 billion, and now they have an offer on the table for 800, which we all know is good, because it's just we've now in a position where we have overly aggressive projections, and then through the course of the project, through this process, you start missing those projections over time, and all of a sudden these projections start coming down. And then they look like somehow they're being manipulated downward to make that $800 million look fair all of a sudden. So it's very dangerous, I think, to start out with a set of projections that are very aggressive.
So what do you
say? There's no doubt when you're putting projections, because any deal is going to take longer than one quarter. You will report something that make sure you're going to hit the numbers that are within the reasonable window that you're going to be, in negotiations for sure.
Right. So what do you do in a situation where you have a view that management's projections are overly optimistic? How do you deal with that?
Well, although we don't verify the projections or independently make any changes to them typically, an important part of our role is to ask a lot of questions. And so if we say, well, you're projecting to grow 50% more than any other company in the industry, why is that? Your margins are projected to be higher than any other company in the industry. Why is that? And through that discourse, you can often have, if you have a good response, then fine. If you have a response that says, maybe we should look at our projections again, which also happens, through that dialogue with the investment bank, there may be something that becomes more reasonable to work with.
You mentioned before the shareholder vote, and Delaware over the last few years has come out with a number of decisions giving more and more weight to the shareholder vote, where that vote is what they call fully informed and not coerced. So what does that mean? Well, fully informed is obvious. All material facts are accurately disclosed in the proxy statement soliciting the vote. And not coerced means the shareholders are not given a choice between voting yes and seeing the value of their stock plummet, which can happen in certain situations. The two main areas this has come up in are a sale of the company, where if it is approved by a majority of shareholders, then the business judgment rule will apply, and the transaction can only be challenged on the grounds of waste, which is almost impossible to meet. And also in what are known as controlling stockholder transactions. So if you got a controlling stockholder, say one person owns more than 50% of the stock, which is not the only way to be a controller, but a classic way. That typically got the highest level of scrutiny from Delaware courts because of the inherent potential for bias in that kind of transaction. Now, if you've got a fully informed stockholder vote and a disinterested board approving the transaction, again, you go back to business judgment rule. And so the courts are saying, look, if you're doing this right and the stockholders approve this, we're not going to second guess. It's their decision. And so, again, the devil's in the details. It does have to be fully informed and uncoerced. But if you do that, you'll withstand scrutiny. Have you seen any changes in process as a result of these kinds of decisions?
Well, with respect to disclosure, usually, so in the proxy there's a section that describes a financial advisor's analysis, and traditionally investment banks have always resisted as much disclosure as they can. Because the more that's disclosed, the more the stockholders can pick away and scrutinize the analysis. And so, our legal department in particular is very sensitive about what's disclosed. But given now that we, the investment bank, is much more protected if there is full disclosure, because, as Jason was talking about, there's been this altering of what's being litigated and how plaintiffs are going after M&A transactions. And a big target is this claim that the financial advisor aided and abetted in a breach of the fiduciary duty of care of the board members. The board members are often exculpated. They are free from liability, or they're liable, but there are no damages. But the investment bank is not sheltered from that, and so they're exposed. So this is kind of new as a result of a case called Rural Metro. So they're going after this, the financial advisor, And the financial advisor is much more exposed than they have been in the past with respect to M&A. And so I think that what you'll see is a change in terms of the views of the financial advisor and are we comfortable with more disclosure? And do you still continue to see that resistance? I know we've had a lot more discussion about what's disclosed, and maybe more disclosure is ultimately protects us more than less.
And by the way, just to pick up, I mean, what Jen was referring to about directors being insulated, I guess, from damages, are in Delaware corporations, stockholders can adopt a provision that does preclude stockholders from getting monetary damages from directors for breaches of due care. And so in the rural metro case, the directors were liable but didn't have to pay any damages, but the financial advisor did.
Over $100 million with, if you include the interest.
Another thing we want to talk about is, which is also in the press a lot these days and the courts, is the concept of a dual class stock structure and how that affects governance. So, right, that's where you have two classes of stock. One has voting rights, the other doesn't. And typically...
Or super voting, 10 votes and the other has 1. Yeah.
The effect is to give control usually to the founders. Facebook, there was a proposal on that recently where Mark Zuckerberg wanted to sell a bunch of stock but keep voting control. That's being litigated. Viacom, Sumner Redstone, has that situation with both Viacom and CBS. He controls it through voting stock. There was litigation alleging that he was mentally incapacitated. He's about 94. And essentially, the controlling stockholder was no longer capable of properly exercising that control. Thoughts on the merits of dual class stock structures?
I've been doing a lot of talking.
Oh.
Should I answer?
Yeah, please.
Okay, so my first view on dual class is, I think that in some cases it's okay, but there are situations where an individual or an entity that has a super vote or has control over the company, they can actually have control, but they don't necessarily have a lot of economic interest in the company. And so because of this super voting structure, they may sell off a lot of their stock, but because of this super voting stock, they still have control. There are situations where that can potentially cause that holder to not be aligned with the other stockholders. They may become more entrenched management. So they're more focused on either keeping their role or their job, but they don't really have the financial incentives to maximize stockholder value, and therefore they're not aligned with the other stockholders. But that only happens, I think, in an extreme situation. It doesn't happen in a lot of the examples that we're seeing right now. But sometimes what happens over time is that it reverts back to that type of situation. And we've been involved where ultimately that structure doesn't make sense anymore. It's not really benefiting the stockholders in any way. And so there may be a collapse of the dual stock structure into one structure again. One of the benefits of it is that if there is some concern that there are activists, it does protect the company potentially against activist stockholders. So it can be a defense mechanism.
There are arguments for it, right? I mean, it arguably insulates someone from pressures of the market a little bit, including activists. You see it mostly with tech companies, so Google, Facebook. I think I've seen articles about if Uber ever goes public, that's the structure they would pursue. You know, there are obviously arguments that could be raised against it. I mean, there's, in theory, no reason why a founder needs voting control, and you know, stockholders should have a right to vote. That's a fundamental premise of stock ownership, the stockholder franchise. But look, you know, stockholders, the market seems to accept it, at least in certain circumstances. The last sort of Delaware topic is appraisals. So when there's a merger under Delaware law, stockholders who dissent, vote no, have a right under the statute to get an appraisal, which essentially is a judge saying, forget what the merger consideration is, what is the fair value of the company on the day of the merger? Appraisal litigation has seen a big uptick. There are a bunch of reasons for that, but it is a sort of burgeoning area, and it also is having some impact on deal terms. Who wants to take appraisal outs?
We were a California corporation.
Okay. I think it's you, Jen.
Okay. So there has been an increase, and financial advisors never go anywhere without tables and charts. So I do have my tables and charts here that shows that appraisal rights are being exercised more and more by stockholders. And a part of that is that there's also, right now, you can get a pretty high interest rate. So let's say that there's a deal, it's for $10 a share, you're a stockholder, you say, I'm going to exercise my appraisal. The court ultimately determines the value. Even if the court agrees with the price, the deal price, at $10, I still make, I think it's 5% plus.
It's 5% over the Fed funds rate.
Right, so that can be 6.5% return just by exercising my appraisal rights. So it's actually not a bad return. And so this has been discovered by arbitrageurs and even new funds that have been formed that use this as an investment strategy to buy the stock after the announcement of the deal, exercise appraisal rights, and maybe they'll get more than 10, maybe it'll be 12 or 15 and do even better. And so there's been this increase in appraisal arbitrage, it's called. So as a result, there are a number of challenges. One, throughout the process, you need to think a little bit more about how do you defend yourself against appraisal? How does this deal look, and how is a court going to view value? For instance, they're probably going to use a discounted cash flow analysis. So how does your DCF look in terms of value? And are you vulnerable from an appraisal standpoint? So there are slightly different considerations, I think, now in terms of process and what the board needs to think about as it says, well, maybe there will be appraisal rights triggered at the end of this process. And buyers need to be aware of it too, because they're the ones that are really dealing with the litigation afterwards.
I mean, it's called appraisal arbitrage because many of these, it's mostly hedge funds and PE firms who come in after the deal is announced and signed up. They buy knowing the deal price for the purpose of seeking appraisal, and that's permissible under Delaware law. And so the issue becomes, you know, what's fair value? And the cases have come out both ways on whether the deal price, the merger consideration, is the most reliable evidence of fair value. And that's going to come back to a lot of what we've been talking about. Was the process good? If you've got a market check, an independent board.
You went out to financial and strategic buyers.
Reasonably reliable financial projections. Court's probably going to find deal price is fair value. If you don't have all of that, it's not likely, and you're back to a DCF analysis.
And one interesting, this is a little bit of a challenge. You may actually have a very thorough process. The other thing to think about is that a court may decide that it wasn't the right time to sell and that you were selling in a trough. And so I think that was in DFC Global. I think that might have come up in Dell. Was it really the right time to sell? And maybe that was the value of that company at that time and the market spoke, but there may be certain vulnerabilities or risks that were inherent in the value at that time, and it might have made sense to wait. And so the court's going to take that into account as well in determining its value.
Right. I think that covers the major issues we wanted to cover. Do folks have questions?
You've spoken exclusively about advising the boards on the sell side situation or an IPO situation. Would you comment on any wrinkles on advising boards of acquiring companies, the boards of acquirers?
So the question is, we've been focusing on sell side advisory. What about the buyer?
Why don't you've done a lot of buy side?
I've done some buy sides, sure.
Okay.
I mean, I think I think there's a different duty, right, that the board has, and I'm not an attorney, so I may say this wrong, but it's, you know, on the one hand, your typical board duty is to exercise good business judgment and looking out for the shareholder value in the business and making sure it's a wise decision and you're paying a reasonable price for a business you're buying, a good strategic fit, et cetera. Whereas I think when you're in the middle of a sale, you have a much more acute, your job is to maximize immediate shareholder value. And you do have to think about long-term, are you better off independent or not for some period of time? So I think there's a difference. And I can tell you from a management standpoint, it's pretty palpable. Meaning, when you're on the buy side, you're seeking your board approval always, and sometimes if it's a large deal, you might have to seek shareholder approval, depends. But you're still driving the process, and you're presenting a case to the board that they're going to kind of, you know, bless or not bless, but you're really driving the process. I think when you're on the sell side, there's a pretty clear point where, as management, you're driving the day-to-day activities, but you're not driving the decision-making process. The board is clearly in charge of the decision, advised by attorneys and bankers, et cetera, and you're helping support all of that. But there's a different role for management, I think a different role for board in those cases.
I mean, I think from a board satisfying its fiduciary duties, it's similar in a lot of ways. They have to be fully informed. It should be conflict-free, but you know, fundamentally, that company will go on, right? It's buying, it's not selling. Whereas if you've got, you know, a cash deal, so if that goes through, there is no selling company anymore. That is obviously a fundamental change. And from a court perspective, it's going to get more scrutiny on the sell side.
Question, or can I jump in? Since I've got the mic, I guess I can do whatever I like. Sunil, can I ask you to comment on both what, in your experience with private company boards, are well-functioning boards, and those, frankly, that are dysfunctional boards? I think the composition of a public company board director is pretty well known, but I think it's less well known the skill sets that make for effective boards. And you've been on a number of private company boards. You know, what do they look like? Who would you want to put on a board to make it functional and avoid what might be, in some instances, some dysfunction?
Sure. So some of the more, I'm thinking about one company in particular, the board we set up over time. You know, at the very beginning of a company, this is a company I got involved at the seed stage. So when they had 5 employees and just a few thousand in revenue, and now it's grown to being a 200-person company with a fully fleshed out board. And so in that window of time, we proactively grew the board. You know, initially the board was 2 of the founders and myself as the preferred lead at the seed round. And so we pretty quickly identified the weaknesses of, between the 3 of us, what we didn't know. And so in that particular instance is we wanted more expertise on sales, and we wanted more expertise on our target customer. And so those were the 2 independent board members that we added. And this is, again, a relatively early stage private company. Those individuals have continued to provide tremendous value because they are independent. They don't I mean, in theory, whenever I speak on a board, I'm speaking on behalf of all shareholders, not just myself, but those individuals have different relationships with the team and with me, and so they can provide pushback in a very unique way. I mean, it's proven 3-4 years later, it's proven to be invaluable to have when the preferred investors are pushing the CEO on a topic. CEO sort of knows that our own biases are coming into play, but when the independent, who was actually somebody that the CEO picked initially, actually agrees, it dramatically changes the whole conversation. So most functional ones are folks where everyone's very honest about the skills they're bringing, and we supplement those, and that everybody speaks their mind and speaks clearly. There's no one-upsmanship, there's no politicking, and everyone's aligned, and so that obviously requires economic incentives, but those are not usually a big issue with these kind of boards. It's really just complementary skill sets without anyone trying to run the show.
I'd like to ask a follow-up, if you don't mind. So actually, Dan, on the public company side, do you find, where is that optimal point as far as board involvement in M&A strategy? Should the board simply respond to deals that are brought forth by the CFO, by corporate development, or should the board be driving M&A strategy? What are your views on what's more effective?
As a potential acquirer?
Yes, yeah,
I'll
deals to
give
do,
you an
deals.
opinion, not that I have a deep experience in that, but I think management should drive an M&A strategy. It should be reviewed by the board. The board should test it, make sure they think it's wise. But I think the management team, who knows the business better, knows the industry better, most likely. Sometimes you have individual board members who may be true experts in an industry or know your customers well. And obviously they're gonna play different roles in some of those conversations. But I think absolutely management, that's just my opinion, should drive those strategies, but make sure the board understands what they're doing and is supportive.
The mic.
Yeah, short question. For early stage company, you want to comment on possible differences between a 409A valuation by an outside party versus a board's internal opinion of its valuation?
So we do this, I mean, for every early stage company, we're producing, we're enlisting an outside firm to create a 409A valuation to value the common share price, which is often, I think there's not supposed to be a rule of thumb, but something like 20, 30, 40% of the preferred share price when it's a Series A company that's years away from liquidity, and I think it converges to the eventual share price. We, on virtually every board that I'm a part of, we use that. I think the math of it is that should be sort of a floor on the share price that we're granting options at. So if the preferred price was $3 and the 409A comes in at $1 per share, then most of the boards that we're on, we set that as our common share price. We usually don't buffer up above that because we push the 409A firms to be conservative in the first place, just to make sure that we fall underneath the safe harbor for 409A protection.
But if there's no investor at that point, if there's no preferred share at that point, is the $1 the common price, or is the $1 the potential preferred price?
Oh, I see. So if there's no, at the very beginning of a company, often at the very beginning of the company, I know at least one story where the founder just gets to pick their own common share price, and they even filled out their own 409A waiver to do so. So there's not a lot of pushback at that point. And I think in practice, there's never been, the 409A sort of safe harbor has never actually, maybe folks on this panel know better, but has never actually been tested by anyone yet either.
But what if the board thinks the 409A is too high and has a rationale for it and disagrees with the 409A? But if the 409A is published and on the table, does the board have the right to ignore it?
So now we're back to companies that have raised money. In practice, the 409A process with the firm is an interactive conversation. So there's sort of lots of different inputs, and there's a little bit of back and forth with the CFO and the 409A to a firm in order to figure out if the right information is included, if up-to-date information is included. So if it's too high, we don't really, as a board, we don't have the authority to change it, but generally the CFO when they present something to us, they feel confident about it, but it's already sort of a polished number by the time that we get it.
Can squeeze in one more question if.
Is there any common trends in regards to why these deals fail before now? There's some common really big mistakes that you see with the boards.
Big mistakes. I think that the biggest area is why we're taking the time to highlight the fact that boards need to be more informed and more involved. I think in the larger cap companies, they have that discipline in place. But it's the mid-cap companies that tend to be a little bit more disengaged sometimes a little less sophisticated, especially with respect to financials. And sometimes even intimidated by their own co-board members about asking a lot of questions. We work a lot with the lawyers as well, because sometimes the lawyers understand some of the issues better than some of the board members in terms of what questions should be asked, what questions should the board members be asking the financial advisor. But there were times when we would give a whole presentation and the board didn't want to ask any questions, and that's just not acceptable. They should be poking holes and interacting and making sure they understand. And it wasn't because they understood it necessarily. It's because they didn't care, they weren't engaged, they were intimidated, whatever it was. And so I think that's something that we're really trying to evangelize and bring that kind of discipline to the middle market and not just the large cap companies.
I think, if you read the Delaware decisions or decisions from other states, they're not hanging boards out to dry for foot faults. It's sort of systemic problems. If you got a board that's trying to do the right thing, is engaged, Delaware courts repeatedly say, we don't require a perfect process, we require a reasonable process. What you see, though, are boards that, are not trying to uncover conflicts. There are situations where boards are beholden to management and doing management's bidding, and management has an agenda. So it's not perfection, but it does come down to, is the board actually trying to do its job? And there are just a lot of situations, usually at smaller companies, where the board is not engaged, not independent, and not trying to inform itself and make a good faith decision, and that comes through.